Well, good afternoon, traders. Chris Weston here, Head of Research at Pepperstone. So one of the instruments that we're seeing continued very, very strong interest in is what's happening in gold. But we've also seen interest in silver and in platinum and palladium as well, and that sort of broader precious metals complex. And not necessarily just to trade it in US dollar terms, but also looking to try and, if you're long, looking to try and neutralise that US dollar exposure and try and take it in a weaker currency such as the Australian dollar, in some cases the euro. So you always want to buy a commodity in the weakest currency, and you want to sell if you're looking for a down move in that commodity in the strongest currency as well. That's where you're going to sort of get your best bang for your buck. But certainly, Aussie dollar denominated gold has been getting some interest, and I think that continues to be a trade as we sort of hone into record highs. If you look at it in US dollar terms, which naturally is where we get the bulk of our flow, they've sort of been trading this 15.90, 15.45 range. That range is still being respected, but I think if we get a breakout of that to the top side, which is probably my base case at the moment, that needs to be respected because we'll probably try and establish a new trading range into 1600. What we're looking at is the sort of technicals and the sort of technical considerations, positioning, risk, reversals, the option structures, and also what's happening in the fundamentals. But if I lay down the fundamental case at the moment, the first point, of course, is what's happening in the US political situation. Now, this is going to get more and more focus as we go on. As we go into the weekend, we are going to be looking at and preparing ourselves for the Iowa caucus that comes out on the 3rd of February. We do get a poll that comes out over the weekend from Des Moines, CNN poll, and that should give us a pretty good idea about how Iowa is going to go. Now, if you have a look at betting expectations through Betfair or some of the betting sites or through some of the modelling sites, they do see Bernie Sanders having about a 60% chance of taking Iowa. He's got a very, very strong chance of taking New Hampshire as well. And that's been a really strong precursor for who gets the Democrat nominee when we get the convention mid-year. At the moment, Bernie Sanders is polling the best. He's certainly, in the eyes of the betting market, the strong contender to take out that Democrat nominee and go head-to-head against Donald Trump on the 3rd of November. Now, I just don't think the world is ready for a Bernie Sanders appointment. I think any chance that we get closer towards Bernie Sanders being a president, and this is not a political view in any way, but the fact that he's going to be looking to take on big tech, the fact he's going to be taking on big Wall Street with his transactional taxes and various other taxes, I think the market's not quite ready for that situation, and certainly we would see some various different hedges being put on. Of course, gold would work very nicely in that situation. So as we go into that Iowa caucus on Monday, I think if we do see Bernie Sanders polling extremely well, we're going to sort of take that momentum and extrapolate what that means for other states as well, and just really solidify the chance that he's going to be running for that Democrat nominee ahead of Joe Biden and Elizabeth Warren and those factors. So I think gold would probably benefit from that. Obviously, if we do see a bit of a surprise relative to expectations, and we do see Joe Biden picking up the slack, then I think gold could probably face some modest downside in that situation. But I think we're going to start using gold a bit more of a hedge around this US political situation. We're starting to get that electoral timetable start to ramp up, and gold will be something that will be quite sensitive and being used very closely as a vehicle around that as well. As we go into next week, we will be looking very closely at US economics. The market's got quite excited that we're going to see a nice snapback in US ISM manufacturing. The manufacturing numbers, which are considered probably one of the more forward-looking ones in terms of the cyclicality of the US economy, is something that we'll be focused on. The market is expecting it to grow at a slower pace, or the pace of slowdown to deteriorate, and actually we're looking for that index to come at 48.4. So if you look at the correlation now, if you can see this chart here between the US gold price and also against negative real yields, the 5-year real yields, you can see they're working inversely. So as the bond market is getting a bid, and we're seeing inflation adjusted 5-year treasuries or 10-year treasuries moving lower and going deeper into negative territory, we're seeing gold prices moving higher. And what we've actually seen, if you look at the 20-day rolling correlation here, you can see that's gone down to sort of into the negative 40 odd percent or negative 0.4 odd in terms of that correlation coefficient. That pace of change is moving down quite sharply, and there's no surprise if we get down into sort of that 80-90% move. So what we're seeing is about 80 or 90% potentially of that variability that we're seeing in gold prices being driven by what's happening in the inflation-adjusted bond market. Now that to me is really important. So as we go into that ISM number, if we do see a downside surprise, we're going to see those yields moving lower, and I think gold's considered a bit of a hedge in that scenario. The idea is that gold doesn't have any yield at all. It actually works perversely as yield in itself. This is where the store of value comes through. So when you're looking at diminishing real returns coming through in the treasury market, people start to see this relative attractiveness playing through in the gold market. Of course, it finds a nice bid in that situation. So we have seen 5-year real yields moving, going deeper into negative territory, currently sitting down about sort of negative 19 basis points. We've seen 10 going into negative 5 or 6. We've seen the Federal Reserve coming out. I think that's quite an interesting concept because we talk about what's happening in liquidity. Liquidity has been very good for things like S&P and some of the global equity markets and also credit. It's been a very, very modest headwind against the US dollar, but we have seen the Federal Reserve saying that they're going to continue with their repo operations, supporting repo markets, and going out with those overnight repo operations. We're through to probably at least April. That should see excess reserves as well as their US Treasury purchase program, which at the moment is running around 60 billion a month. And that should keep excess reserves pushing a little bit higher. At the moment that currently sits at $1.53 trillion. We could see that as high as 1.7 trillion. Now those increased reserves, of course, are very good for risk assets, but it's also, as you can see from this chart, starting to find support as well for what's happening in the gold market. The other one, of course, is we go back to the bond market again, and we can see that the pool of negative yielding debt more broadly, not just in the US, but if we go across the global spectrum into Germany and across Europe and those factors as well, that's been moving sharply higher. That had a big drawdown a few months ago, and that started to tick back up again. So that pool of negative yielding debt has started to increase. Gold has found some solace in that as well. So if we continue to see this pool of negative yielding debt coming back up to sort of 30% of issued debt, then I think that would be a very positive situation for the gold market again. And again, we'll probably take us through there. So we are watching this economics. If we do see a strong ISM manufacturing number, we could probably see real yields moving a bit higher. Nominal yields obviously driving that, and you could probably see a little bit of a steepening of the curve. And I think gold will probably come down to that sort of 15.45 over a bit of time. But I think obviously if we do see weak numbers, the market, as I say, is probably positioned for strong numbers. Then you're going to see gold working quite nicely. And again, so there's the bond market once again that's driving this situation, and also what's happening in politics as well, and also the Fed's balance sheet and the idea of better liquidity in those situations there. Now, if we have a look at risk reversals, I love looking at risk reversals. They are effectively the skew of 1 month 25 delta call optionality and the implied volatility there minus 25 delta put volatility, and you can see that at the moment there's a 2 percentage points or a 2 vol differential between that as in terms of what was pricing for calls relative to puts. Now that tells me that the options market has been better buyers of call volatility over put volatility. Now that, if you look at this chart, you can see that that's not particularly stretched. That sometimes when we've had really strong bull markets in gold, you can see that comes up to 4. So the volatility differential between calls and puts is about 4 vols, and that's when you start getting that extremities. We use the risk reversals, or what we call the skew, to understand the sort of sentiment in the market. If things get too stretched, people getting too euphoric, you see those kind of extreme moves, people really outbidding for call optionalities, giving you that right to buy upside in gold. Now that's come back down to 2, so it just shows that the options market still favours upside moves and a bigger upside move relative to downside moves, but it's not at extremities any at all. If you have a look at the Commitment of Traders report, of course, this looks not just at futures positions. The one I've looked at here has also got optionality in there as well. So we're looking at the positioning. So positioning certainly is not at any kind of all-time highs, but it's somewhat high and elevated levels. That tells me that the futures market and the options market is still pretty bullish on the prospects of gold, certainly far more than what they've been on the downside. But we're not at levels where I'd say that we're genuinely at risk of failing to put on new prices and new contracts in that situation. In terms of implied volatility, we're about the 24th percentile. If we look at 1 month implied volatility in gold, it's not at extremities in any kind of capacity. So we're not too worried about kind of explosive moves. It's going to be a slow grind. And the other thing I really like about gold, if I'm sort of keeping my bull hat on, is that gold is rallying in every currency. The strongest currency over the last 5 days has been the Japanese yen, and gold in the last 5 days is still up 0.5% against the yen if we price gold in yen terms. So I like gold to buy gold, and I like to be involved in the gold market when it's rallying against every G10 currency and most emerging market currencies as well. We kind of think that gold's trading in a currency in its own right in that capacity. Against the US dollar, it's up 1%. So we look to try and buy in the weakest perceived currency. And of course, at the moment, one of those is the NOK, but we like to see that in the Australian dollar, where we're looking at the RBA meeting next week. So the Aussie gold price is looking to record highs. I think in the last 5 days, it's up over 2%. So we like the investment case here. We've got politics. If Bernie Sanders polls very well, yeah, gold probably get a bid as we see people hedging that election risk. In terms of what's happening in the global economy, of course, we're keeping our eye firmly on the coronavirus and the impact that's going to have on the Chinese economy. At the moment, we're seeing Q1 GDP potentially going down and even below 5%. The question is what will the Chinese authorities do to try and save that economic situation, that decline in discretionary spending? And what we're seeing is a knock-on effect, not just there, but also what happens some of the global forces on real yield as well, and that really pays attention to. So their investment case is still there for gold. My favourite is to be long in this situation, but obviously acknowledge that the risks are that Bernie Sanders doesn't poll as well as he wants, and of course we do see some better data coming out of the US. We'll have to see how that goes. But reach out to the team here at Pepperstone if you want more information about trading gold or precious metals with us, and certainly we can give you some more information there.